Good morning. I'm Ben Ayers, Dean of the Terry College of Business, and it's my pleasure to welcome you to our Terry Third Thursday event. This is a monthly breakfast series that we hold here in our Terry Executive Education Center. This is the home of our Executive MBA and our Professional MBA, as well as our executive programs. And on this campus, we hold open enrollment programs, and we also do custom programs for leading companies in Atlanta and the Southeast and beyond. I'd like to take a moment to thank the Alumni Board for organizing today's event and this series, so please join me in thanking them for their efforts. I'd also like to thank our corporate sponsor, Synovus. Thank you for your generous support, as well as our two media sponsors, the Atlanta Business Chronicle, and you've got a gift at your table there from them, as well as Atlanta Public Broadcasting, WABE, and please join me in thanking them. So a couple of announcements before we get started. So next month, we actually will be moving locations. We will host this event for the next couple of months at Synovus's office on Overton Park Drive. We are actually renovating this space, hopefully to begin renovation in early April, subject to approval from the City of Atlanta. And so we're taking more space on this floor. And so when we come back, hopefully in August, this room will not be here. It'll be here, but it'll be different. And our Terry Third Thursday room will be moved around the corner, which will give us a little more space. We're expanding because we're expanding what we're doing in the city of Atlanta. And so we're thrilled about the renovation. It will cause a little bit of disruption, but in the end, we hope that we'll all be happy. A couple other announcements related to construction and renovation. So on campus in Athens, the business learning community is almost complete. My understanding is that the construction company will hand the keys over to us on Monday for our final two buildings, Ivester Hall and Sanford and Barbara Orkin Hall. If you've been to Athens recently, that space looks wonderful. The landscaping is not finished yet, but it will be finished as soon as the rain stops. So we're thrilled about that. I don't know, and whenever that will happen. But it is beautiful space and just a great reflection of the incredible support that we have from our alumni and for the state of Georgia and their support of this six-building, $140 million project. So we're almost there. We'll have the dedication, formal dedication ceremony next fall in September 6th, and hope that you all will join us for that. We're also, in March, we'll be opening our Studio 225, which is accelerator space and incubation space for our campus-wide entrepreneurship program. That's on Broad Street, right next to the Holiday Inn in front of the Spring Hill Suites. That will be finished next month, and so that's 11,000 square foot space. It will be a game changer for student startups at the University of Georgia. So that project will be finished in less than a month, and so we're thrilled for that. And then, of course, we're starting this project, so this is the year of construction and renovation for the Terry College. For our next two meetings, we'll have Dr. Raul Shrivastava, who is the Vice President of Instruction from UGA. He'll be here in March. And then in April, we'll have Coach Tom Crean, who is the head coach of the university's basketball team. And so he'll be here in April. I hope that you'll join us at Synovus in March and April. It is now my pleasure to introduce today's speaker, the Federal Reserve Bank of Atlanta's President, Raphael Bostic. Dr. Bostic has served as President and CEO of the Federal Reserve Bank of Atlanta since June 2017, and in that role, he is a member of the Federal Open Market Committee. The Atlanta Fed plays an important role in setting national monetary policy, in which we're all interested in. It supervises many banking organizations and provides payment services to a variety of financial institutions and the U.S. government. Its territory covers the 6th Federal Reserve District, which includes the great state of Georgia, Alabama, Florida, Mississippi, Tennessee, and parts of Louisiana. President Bostic came to Atlanta from the University of Southern California, where he held the Bedrosian Chair in Governance and Public Enterprise. At USC, he also chaired the Department of Governance, Management, and Public Policy, and also served as interim director of the Lusk Center for Real Estate. From 2009 to 2012, he was Assistant Secretary at the U.S. Department of Housing and Urban Development. He also worked at the Federal Reserve Board of Governors from 1995 to 2000 as an economist and later as a senior economist. President Bostic has served on several boards and advisory committees, including the California Community and Reinvestment Corporation, the Urban Land Institute, the Consumer Financial Protection Bureau, the National Economic Association, and Freddie Mac. He was born in New York City, grew up in New Jersey, and went to Harvard, where he graduated in 1987, and he earned his PhD in economics from Stanford University in 1995. Please join me in welcoming Atlanta Fed President Raphael Bostic.
Good morning, everyone. Can you hear me? All right, very good. It's very good to be here. Thank you, Dean, for the kind introduction. It was thorough. I think you covered pretty much everything there is to know about me. It's always nice to talk to an academic group. Like, this is collegiate, it's good to continue to have ties with universities. When I go around the 6th District, I always make a point to stop on a college campus to try to talk to young people, make sure that they understand the importance of economics and finance and their role in it. Too often I think people are intimidated by the math, by the technical language that economists often use, and really don't see themselves as being able to contribute. And for me, I think our field will be stronger if we have a broader set of people and a larger set of people who participate and engage. So I try to do that as much as possible. And also try to provide some basic understanding about how economies work, what the Federal Reserve does. These are all things that are particularly important, and I think moving forward, they will become more important as people have access to information from a host of places. Some of the information is high quality, and some of it is less high quality. And so equipping people so they can make judgments and draw the appropriate conclusions about what's going on is really important. So what I thought I would do this morning is talk a bit about the Fed, sort of who we are and what we do. Just as a reminder, I know you guys haven't been in the classroom for a while, so I want to just level set us all. And then I'm guessing you want to hear a little bit about my views on where the economy is and policy. So I'll leave a little bit of time for that. And then I'll leave it open up for questions. And I think for these sort of sessions, actually for pretty much all the sessions I do, I prefer to leave a lot of time for questions so that we talk about the things that you're interested in. So Federal Reserve, we are the nation's central bank. We are the banker's bank, if you will. And so we are responsible for overseeing the nation's monetary policy, and really charged with setting an environment that allows our economy to grow in a stable and sustainable way. Our orientation is long-term, so we're really trying to create sort of the space for people to be able to make long-term plans on what they're doing, what they'd like to do, and give businesses an opportunity to provide, to do long-term planning as well. We do that mainly through monetary policy, but we have other charges indeed. We are a bank regulator, so we have responsibility for making sure that the financial sector and the financial system is operating in a safe and sound way and remains resilient. So I have a bunch of bank examiners who go around and investigate banks. I shouldn't say really supervise banks. Investigate sounds too accusatory. So we investigate banks. No, I said it again. See, I've got my media person here, and whenever I say a word, I always look down. So if you see me look down and I change my word, you'll know she just did a nod. So we supervise banks, and we really try to make sure they operate in a safe and sound way. There is basic risk in doing banking. Lending has risk inherent in it. So we're not trying to say that there's no risk taking that should be taken, but we want to make sure that when risks are taken, that our institutions are recognizing the nature of them and are taking safeguards to the extent possible to make sure they're around tomorrow. In addition to that, we have some responsibility and engagement in the payment system. So everyone has, I think most of you still have some cash. I hear more and more that nobody does anything with cash, but in fact, we know that the demand for currency in the U.S. has actually increased considerably since 2010. So cash, the Federal Reserve note, that's ours. If you've ever done a wire transfer, that is done over a Fed backbone that's run out of the Federal Reserve Bank of New York. The Federal Reserve Bank of Atlanta has a retail payments operation, so we facilitate a lot of the clearing and settlement that happens in basic retail transactions. So the Fed touches pretty much everybody every day, and we provide value, and most people have no idea about this. And on some level, that's by design, right? If things are working, then no one has to know anything, just assume the system's gonna work. But I do think it's useful at times for people to understand that we are providing an ongoing service and not just something where we're relevant every 6 weeks when we have our FOMC meeting. We also have in our bank and in other banks a community and economic development function, and that function is really designed to help communities create conditions so that their citizens and businesses can be maximally effective. I'll say a little bit more about our monetary policy in a second, but one of the mandates that we have is maximum employment. And so we then have an interest in making sure that any barriers that are keeping people from being employed and keeping businesses from employing more people are recognized, and then we try to encourage people to address them. Sometimes we have the ability to do that directly, but most times we don't. Most times we have the opportunity to play a consultant's role, if you will, to help communities and to help businesses and others figure out ways that they can be more effective and more engaged with their communities. I'm going to say a bit more about it at the end as I talk a bit about sort of my experiences as the president. But it is important for us to be engaged in that space, and it's important that people know that we do this. You know, I go around a lot, and people have no idea we do that either. So, so this is one area where it's really important. Okay, so let me turn to the economy. So the U.S. economy, by most standard metrics, is doing pretty good. All right, so we've been in a growth trajectory for about 10 years now, coming out of the Great Recession. Unemployment is at historic lows, so 3.8, 3.9%. These are levels of unemployment we have not seen since the 1960s. Job creation is happening at somewhere around the 200,000 to 225,000 jobs a month, new jobs a month clip. These are all extremely strong, and we're not seeing signs of accelerating inflation. So inflation is pretty stable. And this is important because, you know, when we think about the economy's performance, I said earlier, we're trying to be long-term. So we want to make sure the economy is operating in a sustainable way. When signs that is not happening occur when we start to see inflation take off pretty dramatically. That's one of the signs that the economy might be overheating. When we have a very low labor market, unemployment setting, that's putting pressure on employers in terms of wages. Right? So basic supply and demand, the scarcer labor gets, the more we should expect people to have to pay to get that labor. And so what we've known and what we've seen as a historic matter is that when unemployment falls below what most people think of as the natural rate of unemployment, there's a natural churn that happens in labor markets consistently, so that unemployment is never zero. Right? There's always time as people are looking for new jobs, so there's that space. That's called the natural rate. Whenever you fall much below that, you get into sort of a high pressure economy, where there's pressure on wages, pressure on employers to try to compete more aggressively. I don't have the map. Everyone should be subscribed to our macro blog. Right? If you're not, you should please do that. But we just did a macro blog not long ago where we show a map from, I think, 1960 to the present. And just about every time the actual unemployment rate falls below the natural rate of unemployment, a recession follows soon thereafter. There's something that's associated with this high pressure economy, which causes the economy to go in a different direction at some point. So we're close to that now. So if you look at the US government's estimate of where the natural rate is, I think their rate right now is about 4.5%. I think the actual rate is a bit lower than that. There have been a lot of innovations in job search. People can just apply for jobs on their phone now over lunch. Like those sorts of things really improve the speed of job matching and the ability of people to get jobs. And so I think the natural rate is not much above where we are today. But we're close, right? We're close to getting into that high pressure economy, which really says we got to pay attention. We have to be careful. The fact that we are not seeing aggressive wage growth suggests that we're not at that point where are signs of overheating. And as I said to begin with, that's a good thing. That means that we're still in the sustainable space, and that's kind of the stance. Given that, my view is that our policy position should be non-stimulative. Right, so coming out of the Great Recession, our policy basically went to maximum stimulus. We took interest rates effectively to zero. They call it the effective lower band. We increased the size of our balance sheet to provide liquidity in important sectors of the market. That's what people call quantitative easing, so our balance sheet is much larger than it was. And we added a considerable amount of forward guidance. So I'm guessing you guys don't read the statements that come with the FOMC. But we changed them to add a lot of signals about what the direction of policy was going to look like. We call that forward guidance, and there was a lot of that in there. And that was designed to just make sure the market understands kind of where we're going and what we're trying to do. So we were in a maximally stimulative position. We needed to be. Right? The Great Recession was the deepest pain point that we've seen in terms of macroeconomic performance since the Great Depression. And those extraordinary steps, I think, were appropriate given the time. Since then, we're 10 years on now. It's my view we need to let the economy stand on its own. Right? So we've moved interest rates back to a more normal position. We're starting to back off of a bunch of the quantitative easing, so we're reducing the size of the balance sheet. We're not continuing that. And the statements are changing in ways that are removing a bunch of the forward guidance. Because when you're at zero, there's really only one direction to go. Right? So you want the forward guidance to say, well, either we're going to move in that direction when these things happen. That's going to be the nature of forward guidance. But when you're somewhere non-zero, you can go a lot of different ways for many different reasons. Forward guidance becomes difficult. In some instances, it could even be counterproductive in that it could project certainty that we just don't have, given we don't know what's going to happen tomorrow or the next month. So we're in a very different period when we think about monetary policy and how we should approach it. Okay, so then I want to say, where are we going to move forward? I think we're close to neutral now, and you've probably seen the language that we've put out about we're going to be patient, we're going to take a pause, all that sort of language. I think a lot of that really comes from two things primarily. One is that the precise level where neutral is not a specific statistic. It's something that's derived from analytical models and from monitoring the marketplace. And so as you get closer and closer to that, is my view, we need to be more and more careful to make sure we don't overshoot and then take a stance on policy that is actually restrictive. I don't think it's appropriate for us to be restricting policy. And so that's one thing. And then the second reason why I think going slow at this point is appropriate is because there are a lot of things going on. So when I walked in today, actually everywhere I go, people say, it's an interesting time to work at the Fed, isn't it? And the answer is yes, it is. And it's because there are many, many unknowns and uncertainties and moving factors where, depending on how those things shake out, that has real implications for what we should expect the economy to do moving forward. So we have trade policy. There's uncertainty there, both in terms of our relationship with China, or both. Our relationship with China, our relationship with Europe, our relationship with our neighbors, Canada and Mexico. There's uncertainty in all of those. That in the last one, NAFTA, the new NAFTA has not been ratified. Right? And so until that happens, we really don't know what the future is going to look like. China's economy has weakened considerably, and it's been a big driver for economic growth worldwide. It's important for the U.S. as a trade partner. The Eurozone has slowed down considerably. I was in Ireland last week, and they were talking about, heard a lot about different views on whether that slowdown is structural and real, or whether it's associated with some temporary developments from very large companies. Something we have to watch and monitor very closely to understand what's happening. There's Brexit, right? And the changes that arise on the new relationship the United Kingdom will have with Europe has implications for the relationship they're going to have with everybody else. And so that is relevant for us as well. There are issues around immigration. One thing that I've heard from business leaders across the 6th District is there are real concerns about the availability of labor and the availability of workers that have the skills that they need for their businesses. Immigration has historically been a source of some of that workforce, and to the extent that that gets reduced or limited, that puts a constraint on what businesses can do. There are questions about how businesses are going to respond to the tax reform. Right? So they have they had a large reduction in their tax liability, and the question is, what are they going to do with that money? For us, that's very important, because if they produce new technologies from investments that increase the productive capacity of workers, that will increase the productive capacity of the U.S. economy. Right? And then my outlook on sort of how much growth we should expect, or how low unemployment should go before we'll start to see inflation change becomes different. And we can be more bullish on that growth. If they do other things that don't translate into that productivity improvement, then we might expect that growth will not be as robust moving forward, and we'll be on the same long-term trend as we are today, which my team and our model suggests is somewhere in the 1.8 to 2%. That's kind of the long-run productive capacity of the economy currently, with the productivity of workers as we've seen over the last 10 years or so. Right, so that's a lot of stuff, and I didn't cover everything. But depending on how those things fall out, the economy could perform much stronger, or it could weaken a bit moving forward. And so I think it'd be imprudent for us to presuppose a policy pathway given that reality. All right, so that's kind of a big picture of the economy. I wanted to just close by saying a few things about my experience as the president. I grew up in New Jersey, and the last 16 years I lived in Southern California. The closest I had lived to Atlanta, Georgia, was Washington, D.C., and everyone tells me that's not the same place. And so one thing that I had as a real goal was to go around the 6th District, go around Florida, Georgia, Alabama, Mississippi, Tennessee, Louisiana, and just see places. Because these are all places I'm supposed to be representing. I need to understand how they are. So I've been to all the big places: New Orleans, Nashville, Jacksonville, Miami. But I've been to a lot of small places. I've been to Tri-Cities, Tennessee, Muscle Shoals, Alabama, Jackson, Mississippi, Albany, Georgia. Places I never thought I would go, to be honest. But they were very, very interesting. And it really told me a lot about how our economy works and what our economy actually is. And so, for most of what I've been saying today, I've talked about the U.S. economy like it's one thing, like it's a monolith that moves kind of in lockstep. But as I've gone around, what I've seen is that there are a lot of different economies. And some of them are working a lot better than others. All right, so we're here in Atlanta. Atlanta's one of the ones that's working pretty good. I see cranes everywhere. You see new businesses coming in. BlackRock is coming. Emory's expanding. Georgia, you guys are building all over the place. This is a powerful economy. It's growing, and there are a lot of jobs that are being created here, and a lot of opportunities for prosperity. But if you go to other places, if you go to Muscle Shoals, you go to Johnson City in Bristol and Kingsport in Tennessee, you go to Baton Rouge, those places are not nearly as muscular from an economic perspective. Yeah, just go down the road to Macon. That's not that far from here. And you see a very different thing. I've seen people that are concerned that the economy is moving in ways that are leaving their places behind. They're concerned that young people, because they don't see opportunity in those places, are coming to places like Atlanta and Birmingham and Nashville. And they're afraid. They're afraid that their places are going to disappear. And so I've been trying, as part of our outreach, to make people understand that we do have that community and economic development function, and we are there to be a partner with them to help them grow and develop strategies to, if not prevent altogether, slow the pace of stagnation that is happening and allow them to continue to grow. So those are places you might have expected us to see as having a different economy. But I also think it's important to recognize that even in the hot places, even the places where there's a lot of growth and a lot of development, there are multiple economies. Right? So Atlanta, Georgia, most business-friendly state, how many years in a row? Atlanta's creating all these jobs. But Atlanta also has some other statistics that are not nearly as positive. So if you ask the question, and the Brookings Institution did this, they took the 50 largest metro areas, they ranked them according to the likelihood that if you're born poor, you will not be poor when you're an adult. So it's sort of economic mobility out of poverty. And Atlanta ranks 50 out of 50. We're the worst of the top 50 in terms of local people being able to, if you're born without opportunity, to be able to take advantage of opportunity and get to a different station. So there are things that are going on here or that are not going on here that are right under our nose, right? And I will say that our bank, we just finished a strategic planning process, has lifted up improving economic mobility and resilience as one of our key objectives and goals. So we're going to try to do something about it. And when I go around, I try to encourage everyone to think about, well, what are the things that we might do or you might do to help advance this, either with your companies or with your volunteering or just sort of talking about this. Because this is something, I've been talking about this for a fair bit now, and most people have no idea that this is going on here. They hear all the good things. We're not hearing about some of the challenges that we face in this metro area. I was in Birmingham last week, and I was talking about economic development in the context of their challenge. So in Alabama, one of the issues they have is their population is not very healthy, and because it's not healthy, their engagement in the workplace is not very good. Right? So one of the main reasons why Alabamians don't work is because they're too sick or they're in disability. And so their labor force participation rate is below the national average. If they just came to average, that would be 200,000 more people working. Right? That's a real number, right? That's not like 20 folks, right? And so when we think about how we do these things and the things that are needed to do, it's really important to be thoughtful about what some of the challenges and the causes are. And I mentioned in Birmingham that when you have a large part of the workforce that's not engaged, large part of the population that's not engaged in the workforce, that imposes costs on all of us. Right? So we wind up having to pay for a bunch of things in terms of policing, in terms of just support, just basic support, and other things that become a drag on our region. Right? So instead of people being productive, they are now holding us back. And so I think we will all be better off. This is an us issue to try to engage in this stuff. All right, so I was supposed to talk for about 25 minutes, right? So I'm at 23 right now. So let me stop here. No, I'm actually at 27. I went a little long. I'm sorry about that. But let me open it up for questions if you have them, and I'm happy to take whatever you got. And please wait for the mic to come so that we make sure everybody can hear it.
Can you tell us a little bit more about, well, your thoughts on the wealth gap, and either maybe from a macro perspective or even just share some of the success stories from the community development work?
So this is difficult. I'm trying to think about how far should I go on this? No, so one of the great wins of the 20th century was the emergence of a large and robust middle class. All right, and this was an opportunity for a lot of families who did not have histories of affluence to get to a level of comfort that has not really been seen in any other time of human history. Starting in around 1980, we started to see trends where wealth was starting to get more concentrated in a smaller number of households or families. And that trend has gone on pretty continuously since then. So when we talk about wealth inequality, this is not, or the growing wealth inequality, or focus on the 1%, this is not sort of a new phenomenon. It's almost as if this trend has happened, and now it's happened enough that we all notice it. But it's been going on for quite some time. And there are a lot of theories as to what's driving it, and there's not agreement on sort of the causes of this. What we know, though, is that there's been a heightened premium on four-year college education. So any kind of educational gaps are going to exacerbate the wealth gap. We know that there's been a premium on land owning. Right, so if you own property, those properties are appreciated as we have larger populations. So if you owned land before, you're going to be able to accelerate more. Right? So either is an in or out situation. And we know lots of folks, and this is a main contributor, an important contributor to the racial wealth gap, that minorities often were not allowed to own land, or certainly not land that was in desirable places. All right? We know that that I mentioned health as an issue. We know that if people are less healthy, then they're going to be less attached to the workforce. We know that if people are less stable in terms of their housing, right, those are things that are going to make it harder for people. Children don't do well when they are moving every 3 to 6 months. I was talking with the superintendent at the Atlanta Public Schools. She was saying that in some of her schools, more than 50% of the students will not finish the year in that school. Right? It's hard to have a school in that kind of environment. So we got to think about what kind of policies are in place. Now you asked about successes. We never want to end on depressing notes. One of the things we've been trying to do is go around and collect them. So we have a new compendium called Investing in America's Workforce. It's a 3-volume book that really highlights a number of workforce development efforts and ideas that can really reshape and change people's likely trajectory. I'll talk about 2 examples that I think are interesting and have actually I'm going to talk about more than 2, but I'll get to that. So one is, I was in Augusta, Georgia, and they have a program. It's a relatively new program where the local employer has partnered with the school system, and they have identified a number of their students in the school system who are on the verge of dropping out, and said, okay, we'll take those, we'll give them sort of an internship program, we'll do some schooling while they're doing the internship, we'll pay them, and let's see what happens. Well, it turns out that 93%, I think 93% of the school participants, the students, finished school, and they've hired maybe half of them in the firm, and the others are trying to get work for it. Right? That's interesting, because these were people that were on the verge of being lost, and now they have a degree and they have a job. That seems like success to me. In South Carolina, there's a program called Apprenticeships Carolina. And South Carolina has set up a program where if you're an employer and you take on an apprentice, you get a $1,000 tax credit. And they've also set up an opportunity for, if you're a business and you don't know how to do this yourself, there are some program design assistants that can help you set that up, help you set up the program. Because a lot of these things, just designing it to make sure it works with your HR and all that kind of stuff is a challenge, and that can be a burden to prevent people from engaging. The program started a couple years ago, maybe 10 years ago, maybe less than that. They now have 900 employers that do this, and they have 30,000 apprentices. Right, so they're actually getting to scale in a way that is interesting and useful. Here in Atlanta, there are some things going on that I think are potentially interesting, and we're going to try to weigh in as much as possible. So I guess at the end of December, the mayor's office announced a new partnership between Atlanta Trade Tech and Home Depot and Delta and a couple of other employers to do a type of internship specialized training program. Because we know there are a number of professions and fields where there are shortages, or there are soon going to be shortages. And if we can create institutions that allow us to create a pipeline of people into those spaces, we can do much better.
Raphael, if middle to the end of the year, if the economy here does begin to slow for whichever reason you brought up earlier, and rates do need to come down, do you think the Fed would engage in any more quantitative easing in the future, or open market operations similar to 2008, 2009, which was extreme, but do you envision that being a stronger force in the future?
So my view is that our moving of interest rates, the Fed funds rate, is our primary tool. And so if there are things that are going on, that's the lever that I would encourage us to pull most directly. If we ever get to a place where we've gone as far as we can go using that tool, then I think it's reasonable for us to say everything's on the table. Right? Our goal is to make sure the economy operates in a safe and stable way. And if that means we're at a point where more quantitative easing is required, I'd be supportive of that. If we need to introduce new facilities, I'd be supportive of that. I mean, it's really, I guess my view is always whatever it takes. But the balance sheet won't be the first thing that we use. I think it'd be most appropriate for us to use the tool that most people are familiar with, the markets understand, and only when that's exhausted do we go and do other things.
Thank you for being here this morning. I was curious, your reaction. The SunTrust BB&T merger. Many analysts have given many reasons for the merger, but one of the major reasons is scale. Investments in technology is a large factor driving the merger, but another major factor that's driving the merger from a scale perspective is regulatory compliance. You spoke earlier about the bank examiners, the role that the Fed plays in that regard. I'm curious how but you also talked about the mandate under the Humphrey-Hawkins law to ensure that banks are an engine for growth as well. So given this merger, but more broadly, the reaction, the fact that so many banks, all institutions face compliance burdens, but we also are regulated in many ways by social media. So when many firms do things negatively for consumers, their stock price gets hit. My curious is how do you sort of balance the desire to ensure that banks are providing sufficient capital to consumers and corporate clients, while by the same token ensuring that banks abide by sound and safe practices?
So our charge is to make sure that the bank system operates in a safe and sound way. Right. So as I said earlier, we understand that you have to lend. Part of your business is to go out and basically do some handicapping on the likelihood that a proposed activity is going to pay for itself in the long run. I approach this really from our most recent history. All right, so during the Great Recession, more banks failed in the 6th District than anywhere else. There were more foreclosures in the 6th District than anywhere else. Right? And so my goal is to never have to say that again. And so I strongly encourage my examiners, if they see risks that are making them uncomfortable, to bring it up and to say, look, we're going to be proactive and engage with the banks that we oversee so that they are aware of the things that we're worried about. Right? That's our obligation. I feel like that's my obligation as a bank regulator. Banks have to make decisions on their own about what is prudent, who is prudent to lend to, and there are guidelines, and we'll work with them. On some level, our job is to identify risks and say, look, these are risks that are trying to get into maybe a yellow or red zone, and if you're going to be in that space, what kind of facilities or tools do you have in place to manage that risk? If you're comfortable you can manage the risk, try to make us comfortable about that too. And that's the conversation that we continue to have, and I encourage our examiners to have, because again, I want all of our bank institutions to be around, that are here today, to be around next week. Right? And I don't want there to be surprises. I don't want people to say, oh, well, you guys didn't tell anyone that this concentration in commercial real estate was potentially worrisome. I want us to be out there and clear and transparent at every step of the way.
In your capacity, do you think it's more important that you're a good economist or a good leader / manager?
Ooh. So, that's an interesting question. I don't think you have to be an economist to be a Federal Reserve Bank president. And in fact, we have a number of non-economist presidents who I think are very good. Our chair is not an economist, right? So an economist is not a necessary condition for having these roles and being good in them. I think being an economist means that I can focus my time on the distribution of my time differently than a non-economist will. So I know my predecessor had more briefings on the econ stuff and more time spent on that. I've been working on that for a long time, so I didn't need as much of that. I need more time on just what's going on in the building, keeping my finger on the pulse and managing those things. So I think that you can be good at with a variety of characteristics. Leadership is important, and I've learned over the course of my career. I'll say this differently. I've gained a greater appreciation over the course of my career for the importance of leadership. And I probably shouldn't say this, but I'm going to say it anyway. I was an economist. Grad school, the econ department was right next to the business school. I saw a lot of the business folks go through business school, like you guys, all that kind of stuff. And I was really of the view, I guess I understand it, but the value add, I'm not really clear on that. And then I got to some organizations where, and I'll just say, it was my feeling that a lot of this stuff was just common knowledge, it was common sense. If you were sensible, you would just make it happen. Then you get into organizations and you see there's no such thing as common sense, right? Right? You can't assume that everyone just has natural instincts for how to build teams, to nurture teams, to do all those sorts of things. And to be honest, I was really surprised. I was a bit taken aback that you hear stories about, well, so-and-so's in this meeting and they said this, and I'd be like, what? So anyway, but you all know this, right? And you had better insights about how the world worked than I did growing up. I've been playing catch up ever since. But the leadership is quite important, and being able to be transparent and clear and honest and focused, those are things that I think can help institutions be much more effective.
What is an open market committee meeting like? Could you take us through it? And do they have Chick-fil-A?
They do not have Chick-fil-A. Yeah, I got to talk to folks about that. So the way that a FOMC meeting happens, right, is the 7 governors from DC and then the 12 presidents. There's a big table. We all sit around the table. We have assigned seats, so I sit in the same seat every time. And they're very interesting. They really are. There's a lot of econ, so a lot of technical stuff. But the way it works is that we'll have some topics. We go around, the staff will present some things to us. And then we each get a chance to talk about the economy, where we think the economy is, what we're seeing, and then we each get to talk about policy. One thing that is true, but I don't think is fully appreciated, is that all the participants do the same thing every meeting, regardless of whether they have a vote or not. Right? So the detail about whether you're voting has no bearing on your ability to contribute to the meeting and potentially influence the views that are in that meeting. And that's something that I don't think people appreciate. So I voted last year. That was one of my years. I share a seat with 2 other presidents in St. Louis and Dallas. But I get the same floor time as everybody else, and I have an opportunity to be as vocal and as pointed as anybody else. And I will say I'm trying to do a good job representing the 6th District to make sure that people in Washington and around the country see or learn what I've seen in my time going around. And I think it's useful because the 6th District in many ways is a microcosm of the US economy. If you took business sectors and you said, what percentage of sector X does that represent for the US economy? The 6th District is almost exactly the same. Right, so in many regards, we are the US economy, a mini version. And so what I see here in the 6th District, I think actually is a good signal of what's happening more broadly. So I try to be pretty direct, pretty clear about what we're understanding and how we're understanding it. Oh, microphone. It's coming.
I just wanted, since your focus is the 6th District, and Atlanta is a big part of, at least this part of it, do you have any concerns about the stage of the real estate development market? What's going on here? I mean, you're concerned about banks and lending. We've got a very robust construction and development stage right now. Just would appreciate your comments on that.
So I have a team in our supervisory group that spends a lot of time trying to identify hot markets, right? Those markets that are potential hot spots that could be troublesome moving forward. Now, what they've told me is that there are growing concentrations that are making people more nervous, but it's not making them scared, right? And so on some level, we know real estate is a cyclical business. Right? There's going to be some up and down that happens periodically. What we want to prevent, though, is the propagation of a lot of decision making that is based on hyper optimism, right? And so, I actually, when I was at USC, I ran a real estate development program. That was one of the things I did, and so I talked to a lot of developers in the West Coast, and they started talking about cap rates going to 3%, 2.5%, that kind of stuff. And projections, the only way that made sense was if you could increase rents 6, 7, 8% a year, right? That's hyper-optimism, and that's happening on every deal. And when you start to see that, then you should get scared, right? We're not seeing that district-wide. Maybe in like some specific projects you're seeing that, but it has not become systemic in a way that has raised the hairs on the back of my neck. I will say we've provided some guidance more generally as a system to encourage bank institutions to pay attention to their concentration in commercial real estate in particular, because that's one where the boom bust tends to happen a bit quicker.
A number of smaller cities in the state are recovering from the recession, but it's very difficult for them to get construction to build housing in their inner city, and it seems like we need something to provide some economic incentives or capital or something, because, I mean, Dalton, for instance, I was doing some things up there. City's improving, it's doing much better, but you can't get anything built there because it just, the economics don't make sense yet.
That may be true.
The question is there a way that we can spur development
So I think-
in these
yeah.
secondary and tertiary markets?
I would think about it a little differently, which is, are there ways to create business plans and a workforce so that the economics works, right? So I'd focus much more on sort of the underlying economic activity in those places, and then try to have the real estate support those things, because I think that's where you get to a much more sustainable picture. But I don't know a lot about the situation in Dalton specifically. Maybe there are things there that warrant some investment, and the banking system is not yet aware of it. You got the mic.
Thank you. Thank you for speaking with us this morning. One comment I wanted to make, which is kind of congratulations on your part, is with the Regional Economic Information Network for the 6th District. I think it contributes to the Atlanta Fed being more data rich than some of the other districts. And my question is when hearing from these businesses in the 6th District, it seems to me that a lot of business owners, whether small or larger, have similar issues whenever it comes to labor markets, which is matching the skill set of what's needed for those companies and the skill set of what's currently available in the labor market. And I was wondering if that is currently contributing to some of the production slack that we're seeing right now in regards to overall economic conditions, because it seems to me that there's a lot of things where we have the recipes to have a greater inflation than we do right now, a greater, I guess the PCE, which you guys measure, could be greater if we didn't have quite the production slack. And I didn't know if that's something in regards to the current labor market and conditions right now, or if it's something else such as demographics.
So you put a whole lot in that.
Sorry.
So let me start with the Regional Economic Information Network. So one thing that we've done at our bank, which started before I got here, but which I'm really grateful exists, is we set up a structure where we have people called regional executives, and their job is basically to drive around and talk to CEOs and to try to get a sense of what's working, what's not working, where are the challenges, what are the things they're worrying about, all that kind of stuff. And this is a supplement to the aggregate data you get on GDP and unemployment and labor force participation, all that kind of stuff. And over the course of one FOMC cycle, so that's over a 6-week period, our regional executives will talk to anywhere between 60 and 100 CEOs and executives, right? And then we come together and they try to distill it down and see if there are themes or common messages that we're getting from those CEOs that can tell us something about how the economy is actually working. And this is important because it can validate some of the aggregate data, but it also can, in some sense, in some circumstances, be a leading indicator. Because it's my view that just about every trend that eventually emerges shows up in people's lives before it shows up in the data. So if we can get that information beforehand, we can be on top of things and be very timely. And so I really value the network, and I value the efforts in that regard. We do hear consistently, and since I've been in this job, there's been a constant drumbeat on we can't find workers that have the skills that I need. Right? And the skills sometimes are the technical skills, sometimes they're the soft skills about how do you behave in the workplace. Whatever it is, people are facing those challenges. Then the question is, there are two questions. One is, I always ask them, what are you doing about it? Right? So there may be people out there that have the skills. Are you bidding more for them? Are you doing the things to be more competitive? And for the most part, they haven't been. Now, they're starting to do that a bit more in the last quarter or so, But for the first year I was here, they're like, no, we're not really gonna push up wages. And that's a whole nother conversation to have there. What I wanted to focus on though was sort of our response as a bank. So we set up very soon after I started a Center on Workforce Development, which is really designed to start a conversation and to try to spark some action to try to help people transition their skill set to become more competitive and more connected to the skills for tomorrow. Right? And so we are identifying those types of skills that people need, and then we go and talk to educators, employers, community colleges and the like, to encourage them to find ways to develop programs so people can get those skills. Because we can cry about this all we want, but change is happening, right? And our workforce needs to be able to serve that change and be a contributor to that change. And those are the things that we're going to try to do at the Fed to try to make sure that we have institutions and that can create those pipelines to those positions.
I just have a question. You'd said the Fed's first choice would be to lower rates if there were some sort of recession. We've been in a very long downturn or downward trend in rates for 35 years or so. My question is, what are your thoughts on negative interest rates versus quantitative easing? And would the Fed actually consider that?
So I would say that the Fed will consider anything it needs to, right? I mean, there's one message you should get is I'm open to anything, is that whatever it takes to make things work. Negative interest rates, I think, are difficult. And I think they're difficult conceptually for consumers and businesses, right? And so I think there would be some more straightforward tools that you could approach and consider before I'd want to go there. But if that's the last thing you got, then you do what you got to do, right? So I want to make it clear, like, I'm not locked into anything, and if you're in a crisis, it requires like crisis management. Over here.
I know this question might be a little different, but I'm just curious your thoughts about, I know cryptocurrency is still relatively new and whatnot, but what are your thoughts on the future of cryptocurrencies and integration into our economy?
I have no idea.
Okay, totally understand.
So here's here's what I would say on the crypto space. Right now, the way these markets work, they don't function like currency. Right? The markets operate much more like a speculative asset market, and if they continue to operate like that, I don't see them getting to a scale where they would replace like real currency. I don't see that. I've been talking to a lot of people recently where they're like, oh, forget the crypto space. That's not real. But blockchain as a technology might have some applications, right? Today, I don't know of any business models that really employ blockchain at a way that is sustainable, that's producing regular revenues that exceed costs, right? Today. But I know there are thousands of people out there working to try to find that. And I'm not an innovator in that space, so I can't really predict what it's going to look like. But I know people are trying really hard to make that happen. And when that happens, then I'll have to have an opinion on what we need to do about it. But at this point, we're really in the R&D phase for the development of product associated with that technology. Yep.
Being here today. I just wanted to ask your thoughts on how the Fed is handling from the top down the pressure from the president as it relates to rates.
pretty much just like that, right? So my job is really to understand what's going on in the 6th District, bring that information to Washington, and provide information about my best thoughts on what our long-term policy should be. There's a lot of stuff that goes around, right? You guys watch Bloomberg or CNBC or whatever. There are talking heads that talk about us continuously. What should we do? How should we do it? And I keep my head down, right? So for me, all the stuff that's on the outside, that's not giving us insights as to how the economy is actually working, that's one of the reasons why we talk to CEOs. I try to give that no weight to the extent possible and really focus on the task at hand and the independence of the Fed, our ability to be a longer term, to be an institution that has a long view, I think is tremendously valuable because, as I said at the very beginning, our job is to create an environment so that others can make decisions, businesses and families and households. If that environment starts lurching around based on issue of the moment or the issue of the hour, right, how do you make those plans? Now, I don't know how you do it with any confidence. And so I think that things that undermine belief that we are holding on to that long view, we need to speak to. And so for me, I'm going to continue to have the long view. I'm going to continue to make sure that my consideration of the policy perspective is with that long view in mind. And I want to make sure everybody understands that as clearly and explicitly as possible.
A quick question for you on the reality of automation. So I'm wondering, from your perspective within the 6th District, does automation excite you from a productivity standpoint, or does it worry you from an employment standpoint?
Does it excite me or worry me? I'm excitedly worried. Okay, let me try to place it in a broader context. All right, so what we know is that in the history of the United States, technology has disrupted industry from the very beginning. Right, so if you were in the 1820s, 1830s, pretty much everyone was a farmer. Right, then we got some machines, some technology, and now less than 2% of our workforce are farmers. Now we produce more food, we actually are far more productive. Those farmers who are no longer farming found other things to do. Right, so we have, for over a long arc of history, been in a disruption, repositioned space. And that will continue. You know, when I talk to employers who are introducing automation solutions to their production, what they tell me is that even when we put in the machines, we still need something close to at least 80% of the workers that we had before. Right, so there are jobs. The difference, and it's a big difference from sort of the Industrial Revolution, is that the skills to do those new jobs are really different than the skills for the people who were there before, like really different. And so you will get the same number of jobs or close to that, but you'll still get 100% turnover. Right? And so in that regard, and this is one of the reasons why we're spending a lot of time talking about workforce development. Right? To the extent that you can get those people with the old skills and quickly transition them to get to those new skills, then maybe that turnover is less. Maybe the disruption in families' experiences is lower. And so we can navigate these transitions much more smoothly. The thing that I think is a challenge is that this old skill, new skill gap is, I think, maybe wider today than it's been in maybe our history, right? And so in a period where the gap was relatively small, we didn't need formal systems to facilitate that change. But when the gap is wide, now you're asking a lot for 100,000 individuals to all figure out on their own how they're going to get skills that are potentially very distant from their experience or their knowledge. That's asking a lot of them, right? And if we don't do that well, then the amount of disruption we're going to have is going to be pretty significant. And so we're trying to get out in front of that, start to have conversations on this, so that those institutional systems are in place and that transition is minimized, or the pain of that transition is minimized.
Here we go. My son lives in Hong Kong right now, and he's interested in the U.S. dollar versus the Hong Kong, the Chinese yuan, and what's the future of the currency stability there?
I have no idea. All right, so
Give us some comments on it.
I can talk. I mean, I'm a professor. That, you know, we're paid to talk in 2-hour increments, right? So there's a lot of uncertainty where China is concerned, and you mentioned Hong Kong. The China-Hong Kong relationship is fraught with uncertainty, right? And so how there are a lot of things that are going to happen in a relatively short amount of time. You know, Hong Kong has been in this two Chinas regime. I know a lot of people in Hong Kong don't believe that's going to persist for a very long time. And if that change happens, there could be significant transitions of capital and workforce and a lot of things, and I don't really have good sight lines into what those transitions might look like. So there's uncertainty there. Then you look at the U.S.-China trade relationship, right? And how those negotiations turn out will have pretty large implications for the exchange rate relationship. And then there's just the there are basic issues in China about their economic slowdown and how persistent is that going to be? What steps might the Chinese government take to mitigate that? That will have implications as well. And then there's a lot of public debt in China. And the world has been able to support that. How long will that continue? Will that continue? I don't know. So there's a lot of uncertainty associated with that. And you know, this is another one. We're just going to have to watch. And you know, I've asked my team. You know, in this era, I ticked off a bunch of uncertainties. We got to pay attention to all of them. We have to be very alert and really have our finger on the pulse of all these things, so that as they happen, we can understand what the implications are going to be for our economy, so that our policy can be most effective.
Thank you very much.
Thank you.
So we really appreciate you being with us today. Fascinating talk, and your leadership in the 6th District, as well as your relationship to the University of Georgia and Terry College. And on behalf of the Terry College, I'm going to present to you this nice red and black sculpture to remember today. Thank you very much.
Thank you very much. I really appreciate it.
I also appreciate the plug that President Bostic put in for